Good afternoon and a warm welcome, everybody. I am Angelica Kinney, your host for the webinar today, and let's dive straight into it. In today's webinar, we are going to delve into topics such as how much to invest based on your income, from choosing the right funds to maximizing returns, learn how SIPs and lump sum investments build your portfolio, and unveil the do's and don'ts of mutual fund investing. To understand this better, it is my pleasure to introduce Mr. Shyamac Jal. Mr. Shyamac Jal is the segment head of retail business development at Nippon India Mutual Fund. He possesses 21 years of experience in the banking, financial services, and insurance sector. Having overseen various verticals throughout his career, Sir surely brings a wealth of knowledge and expertise to our webinar today. Before moving ahead with the session, please know that if you have any questions, please send them in the comment box and we would take those up towards the end of the session. Sir, over to you.
Thank you. Welcome, everyone. Very glad to be a part of this webinar. The equity markets have always been a great fascination for all of us. They've known to give you returns over a longer period of time. And today's presentation is discussed purely on how we can save tax by investing over the equity route. Now, when we have to save tax, that is something that all of us in the country want. How can we save tax? How can we have a little bit of more liquidity in our hand? And the government over a period of time has offered us various tax saving tools. Primarily, one that we know and we're very familiar with is your public provident fund. The other one is introduced a few years back. That was your fixed deposits for 5 years. And there were various other schemes time to time that the government of India has launched. The only one that is launched over a period of time on the equity side would be an ELSS tax saving fund. Now, what happens here is this also gives you the same tax benefit as an ATC fund under the ATC benefit. But the slight difference is that unlike your public provident fund and bank FDs, here the investments are directly in the equity in the equity space. And the other advantage that you have on this fund is there's a statutory lock-in for 3 years, and all other ATC funds would offer you various other time frames for investing. So that's broadly what an ELSS fund is. It's a pure equity investing fund that invests across the equity space and gives you a tax benefit under ATC. There is a lock-in for 3 years, and this fund does not carry an exit load, but you cannot remove the investment before the period of 3 years is over. So this is what an ELSS fund ideally is. And an ELSS fund gives you the capital appreciation benefits. It invests in equity and equity-related instruments, right? And this is what the fund is all about. So if we can move to the next slide. Now, whenever we invest in equity funds, every equity fund carries a separate strategy, carries a separate way of investing. And what we at Nippon have done is all the funds that we have are cased in a structure where the investor knows exactly where we are investing money. So we have an investment framework. Now, what is the investment framework that we uh, deploy for our ELSS fund? Now, the first thing that we do for our ELSS fund is that the minimum exposure to this fund at any point of time in the large cap space will be a minimum 50%. Right? So 50% of allocation towards the fund will at all given times be in the large cap space. 50% of exposure will be in the top weighted stocks in the benchmark. Now, what advantage that gives you is that this is a fund which, because although it's investing in equity funds, it would carry a slightly lesser amount of risk because I've limited my minimum exposure to mid and small caps to less than 50% or less than 50%. Now, over a period of time, we also have ratings of all stocks from A, B, C, and D. Now, what we mean by A, B, C, and D is that there are various stocks that work under various cycles, and there are a few stocks that work under all market cycles. the type of stocks or the companies that we invest in, and we categorize them in C and D, are those which will require a certain set of parameters to function, right? So those are ranked as C and D. They could be more cyclical in nature, and hence the capping on them is that we don't invest anything beyond 5% in D category and 15% in C category stocks. When these market conditions of these companies or these sectors improve, we will increase allocation because they move into A and B category. The other thing that we mention is the active share is in the range of 45 to 60%. So what we try to do here is we don't replicate the index. We are broad. We take tactical calls, but overall we don't move away from the market beyond 45 to 60%. So that is exactly how we manage this whole fund, right? The second part of the discussion is how do we construct the portfolio. So the portfolio is constructed on the way of it's a bottom up approach, right? So we select the stocks, right? And from there we move up. We are market cap agnostic, although we say that 50% of the money will be in the large cap space. We do not only have a large cap based portfolio. We will invest up to 50% in large cap minimum, and the rest is in mid and small cap. But we don't have a particular casing on how much money I will invest in the mid cap or the small cap space. The fund is sector agnostic. It doesn't follow a particular sector. Sector styles, as we see in later stages, allocations will keep moving across sectors, and depending on what sector has the best to offer us over a period of time. Right? Now, all funds will carry a particular core strategy, and there is a tactical allocation that we also do in the fund, right? So core means this is the basic framework of your fund. This is what the themes will be of the fund, and the tactical approaches from time to time will increase and decrease depending on the market condition of the sectors and the stocks. The whole idea when we are investing in these stocks is that the companies that I choose should have a compounding characteristic. What I mean to say that is that the business that the stocks that I will hold, there would be stocks in that where the results and the business should be compounding at a faster rate than the other businesses and other stocks. Okay. We also take a tactical approach depending on market specific, industry specific, and company specific developments. A lot of things keep changing from time to time. A lot of sectors become undervalued. A lot of industries, the spurt of business suddenly shoots up depending on government policy, depending on external factors. A lot of companies start to do extremely well. They gain a lot of market share. They gain a lot of credibility in the market. The stock prices of them go up. So we do take a tactical call on these. What we don't do is we do not hold large cash positions under any circumstances. So whatever money that we have, other than the money that is required, 3 or 5% maximum, the rest is all deployed in the markets instantly. So we do not take a cash call. We do not say we expect the markets to come down. We expect the markets to do well. We'll increase allocation, decrease allocation. At all times, we are fully deployed in the market, leaving aside a few amount of cash for liquidity reasons and for redemption purposes. So that is what the whole structure is based on. We follow a bottom up approach. We are market agnostic. We don't give more weightage to any market cap. We don't give more weightage to any sector. But at the same time, 50% of allocation at any given time will be in the large cap space. We don't have a fixed allocation for mid and small cap. We are not sector specific. We don't follow a particular sector. We are diversified in nature. We don't take cash calls. We have a bottom up approach, and we do take advantage of the markets from time to time. So that's the whole investment framework on how an ELSS fund works. So this is what, when we talk of an ELSS investing, and the whole idea is that the reasons why this is done is because the investment horizon for the investor is about 3 years minimum. So after 3 years, the investor can exit the fund at any given time. First 3 years, he's not allowed to invest. Now, going to this sector allocation trend, this will give you a clearer idea on how we have invested over a period of time, quarter to quarter, on various sectors. Now, banks and financial sectors do carry the largest weightage in the BSC 5, BSC 100, right? So a larger allocation is given to them because the sector allocation to banks and finances is very high, but this will keep on increasing and decreasing over a period of time, and other sectors will come in and move out. Like if you see ferrous metals at one time, industry manufacturing, we came in and we exited, agriculture and commercial vehicles, they're all tactical calls that we took and which were very successful. Then there is FMCG as a larger space, diversified petroleum products is one, industrial products is one. So the allocation to these on a quarter to quarter is what we've shown here. The allocations keep changing on a month to month depending on what the fund managers calls over a longer period of time work out to be. So just give an example, in March 2022, our auto component was at about less than 4%. By September to 24, that's about 2.5 years, it increased to about 7.63%. So we nearly doubled the exposure because the auto industry was doing well and expected to do very well in future. So that's the way we keep moving between sectors. This is not market cap based driven. It's more to do with sector allocations. So that's the whole theme here. And if you can see, there are some spaces like aero and dynamics. We did take some space. We moved out. Now, this slide is extremely important because this slide talks about the active allocation on the fund, the active weight on the fund. Now, what we've done here is this will I'll explain to you what this exactly is. Now, the index carries a certain weightage among all the sectors. Now, either I can, if I take the similar weightage and the similar stocks, I'll be replicating the index. Okay, now since this is an active fund, actively managed fund, what we do is we try to take allocation somewhere higher and somewhere lower. Now, the whole idea is that if I've taken a higher allocation somewhere, have I gained because of that or have I lost because of that? So the top 5 allocations that we've taken in financial spaces, we've taken an active weight, average weight of 7.45%. And because of that, okay, the fund did well by about 0.16%. So that is the way, that is how you actually see whether the fund has done well or not. The fund manager's calls have been right or wrong. At the same time, we would have also taken, because I've taken an active weight somewhere else, I'll have to reduce my percentage of weight somewhere else. And by reducing the percentage of weight, have I gained or not gained? So this is a combination of these two things. For example, in information and technology, we were lower, and because we were lower, we actually lost out. But in energy, because we were lower, we actually gained. So it's a combination of these two things, that either my weightage is more and I've gained or lost, or if my weightage is less, whether I've gained or lost. This is on the sector part of it. Okay, on the weight part of it also, if you see the stock position in particular, you have ICICI Limited Bank, where our active average weight is about 3.16%. And because of that, we've gained 0.08%. At the same time, if we see Radico Khaitan, the second last stock in the list, we took an active call by 1.54% and we gained nearly 0.5% more. At the same time, ICICI Lombard General Insurance, we took an active position of 1.6, but it did not do as well as the other stocks, and hence we went down by about 0.22%. So that's the whole way on how this actually works out. By taking active calls, how much we gain, how much we lose, and that's exactly where the strength of the fund manager and the fund is highlighted in detail. Either positively or negatively, depending on whether I'm underweight or overweight on the index. Now, what is the current position that we have? Okay, so currently, as always, we are diversified in nature. We take investments across. Can I just have the slide back, please? The previous slide. We are absolutely diversified. Banking and finance is one space which is the highest weightage, and we have a very active call. Even if you see the top holdings, ICICI, HDFC carry the maximum holding. Consumer discretionary is one sector which we're very bullish on. Your utilities, another sector we are very bullish on. Communications and consumer staples we are very bullish on. What we are not bullish on is materials. What we are not bullish on is information technology, energy. So here the weightage will be far low. So wherever, so this is an active call. This what you see today will not be true tomorrow or 1 month, 6 months down the line. We might hold this position, we might not hold this position. So this is not a recommendation. This is the way we are running the fund right now. Now, another thing that we have to understand is that this fund carries across this fund, we carry a blend of value and growth. So it is not either value or growth that we run this fund strategy on. It's a combination of value and growth. Okay. But the portfolio is tilted right now towards financials, capex, and discretionary. Okay. Keeping in mind the domestic demand in the country right now. So this is what the portfolio is currently tilted towards. Okay, with times changing, with other sectors doing well, some not doing well, this will change. Now these are the top weightages that we have and stocks. These are the top sectors that we have in stock. So ICICI Bank would be 8.26%, HDFC Bank would be 6.88%. Now if you look at the top 10 sectors, in the previous slide I told you we are not very bullish on IT. Okay, but in this particular sector sheet, I'm showing you that the top three sectors, IT is number three, right, at 6.56%. Because IT carries a larger weight in the index, I have taken an allocation lower than what the index has to offer. So that is what we mean by saying tilted towards or against it. It could be the third largest holding in my portfolio, but the sector weightage in the index being higher, we've taken a call right now of going lower than this. If you see banks, we have State Bank of India, we have Axis. So it's a combination of growth and value in the portfolio, not tilted towards one particular style of investing at all. This is the market cap allocation. Although we have a minimum allocation required in large cap at 50%, currently we are sitting at 69%. Mid cap we have 15%, and small cap is 16%. So right now we are more tilted towards the large cap space, significantly more tilted towards the large cap space. So this is what we meant by saying we are not sector specific. I mean, we do not have a cap on sectors, although the primary concern is that you can't go below 50% on the large cap space, and 69% is what we are holding in the large cap space right now. 15 in the mid cap, and 16 in the small cap space. So this is what the whole fund is all about. If I can just have the previous slide again. So this is what the whole fund is all about. This fund is about, it's more than 15 years old in the system. We manage about 15,000 crores of assets in this particular fund, which is opened by SIP, and this. The preferred investment amount in this fund is about 1.5 lakh rupees, because that is the amount that is required for tax saving, and that's the benefit that you get on this particular fund. So now I'll open if there are any questions, I'll gladly take them up, or we can talk about anything that you'd want to discuss with regards to this. Yeah, Angelica. Yeah, so this is how the next slide, please. This is how the fund has performed over a period of time. Okay, and against its index that we normally follow, the Nifty 500, because when we are investing across market caps, it's large cap, mid cap, and small cap. We normally invest across its only investments are all done in the top 500 companies with 60% of the allocation uh, based on the weight in the large cap space. Haji. The current fund manager is Rupesh Patel. He's been managing the fund since Jan 2023, and the fund has um, hopefully delivered good returns. So these are the returns. The source is MFI in Explorer as on 31st December 2024. Yeah. Yeah, Angelica, we can take up questions right now.
So this webinar was truly insightful, and we've all learned something from today's webinar and how it can be beneficial. And we would like to open the floor for any comments or any questions that the audience has. So we'll just go ahead and pick up a few comments as well. We have a question from Siddharth Malik. Sir, will restrictions on small cap funds ever be removed in future as DIP are not buyable?
Okay, so Siddharth, I believe this is a question that you're asking us about our Nippon India Small Cap Fund, right? So currently we have a restriction of investing 50,000 rupees or either via the SIP or the STP route. We do not allow lump sum investments in this fund. At the moment, we have not opened up this fund for subscription, but as and when the time is right, and as and when the fund manager believes that there will be sufficient, leeway to invest in the small cap category in a big way, we probably open up the fund. But as of now, there is no particular uh, call that the fund house has taken.
We have another question from Banu, sir. How to check our mutual fund performance? Which parameters we should take a look for?
So, yeah, see, performance of the fund, performance of a mutual fund depends upon a lot of criterias. It depends upon when we came in. It depends upon the market conditions. It depends upon what is happening around us. It also depends upon the type of fund that I've invested in. Now, for example, if there is a large cap rally in the market and we are not in the large cap space, probably our performance will not be as good as the performance of the large cap space. So probably if we are in the if you have a sectorial call, we've taken a sector stock and the sector doesn't do well, the market does better than the sector, and hence we feel that the performance is not good. But ideally, if you're holding a diversified portfolio, and ideally if you're holding one where you have a long term based on the call, market cycles do change, and across the board there is, depending on where you put the money, there is a certain expectation of the fund, and that's normally fulfilled. So comparisons between different categories, comparison between different sectors would not be, right at this moment unless we have more clarity on what exactly is that you're looking for. But right now, a lot of factors affect performance of the fund. So I think your advisor would be the best person to help you out there.
We have another question from Mukesh Poyer. What is the right time to invest in mutual funds through SIP or lump sum?
Sir, I always believe this is the best time to invest in the equity markets. So with everyone talking about a golden period of next, India is a growing economy. We've done fairly well on the economic front. So in terms of SIP, whenever you start, it's a good time, because what happens is you are not buying, all your investments don't happen in one shot. So you're investing from now over the next 10, 15, 20 years. So you'll always get an average price. So an SIP, you can do it at any given time. You will take the benefit. If you wish to enter via a lump sum route, if you have lump sum money right now, then whenever you do it, I mean, this is not a call regarding today or tomorrow, but whenever you do it, it's very prudent to come in via six, over a period of 3 to 6 months, and so you can get the upside and the downside, whatever the market has to offer. But SIP, you can come in and you can start at any given time.
We have another question from Mukesh Boyer. Which parameter should a small investor use for investing in a mutual fund?
So a diversity for whether he's a small investor or a big investor. Okay, the core principle remains the same. Your portfolio should be well diversified, right? You should look at a fund house which has stood the test of time. You should invest in more diversified schemes, multi-cap, large cap, flexi cap funds, which are diversified in nature, and build a portfolio over a period of time, but be as diversified as possible. So one parameter that you should look at is always diversification. At any given time, some fund will do well, some will not do well. It's a business cycle, but diversification always helps you.
We have one more question from Siddharth Malik. So, investment is precious metals via mutual fund for long term using SIP route. Your advice?
You see, when we come via and you see the basic advantage of a mutual fund investment is you can invest a very small amount on a month-to-month basis also, or a weekly basis also. So if someone wants to come in at by investing 500 or 5,000 rupees on a month, per month, he comes via the mutual fund route, because you can't buy precious metals worth 500 or 5,000 rupees every month. It's more prudent to come in through a mutual fund route. One, you're not holding the metal itself, it's safely kept in with the custodian, and plus it's a easier mode to invest in, basically speaking. So it's not tedious that every month you have to go and buy it. And whether you can see the basic idea for mutual fund, whether it's precious metals or equity, is you can diversify your portfolio and you are able to buy a lot of stocks because with a smaller amount of money. Now, that same concept holds true for precious metals also. So if I want to buy a precious metal and I want to put in 5,000 rupees a month, it becomes difficult for me to buy, a precious metal worth 5,000 rupees on a month-to-month basis. So that's the difference between investing directly or via the mutual fund business. But end of the day, an SIP, whether it's in precious metals or in the equity markets, it always benefits the investor. So SIP is by far the best route. Now, that's true for any investment anywhere across. However, if the person is in, suppose someone says that I have enough money to buy month on month, then he can go month on month also, buy the precious metal directly on a month to month also. SIP is just a way of getting in a smaller amount of investing done over a longer period of time.
That's all the questions. Thank you, sir, for your insights on the fund. Your expertise and passion for this subject were evident throughout your talk. We appreciate you taking the time to share valuable insights with our audiences. Thank you once again.
Thank you so much, Angelica. It was a pleasure. Thank you. All the very
Thank
best.
you.
Thank you.
Thank you.